Good morning, everyone. I think you have been forever robbed of snow days. Actually, is it snowing in Boston yet? No? Okay. Okay. Let me put my headphones in. That's better. Can you hear me now? All right, let me put on my screen. Okay. All right. So we are going to pick up where we left off last class. Actually, we're going to do a little review because we had started scatter plots. So we're just going to kind of go back and do that again. That was one of the three methods of predicting a mixed cost. But before we do that, I just want to go over a little bit of what we talked about last class. Right, so you were introduced to taking our expenses and then determining whether they were variable, fixed, or mixed, right? How to identify them. So a variable cost, remember, per unit is constant, and variable costs in total are going to fluctuate with your activity, right? So we looked at lots of different examples of how to identify that cost. And then we looked at how to predict what a variable cost would look like in the future. Once you know that variable cost per unit, that constant, then you just multiply it by whatever volume I gave you. Remember, I gave you 50,000 units or 60,000 units when we were predicting that material cost. Once you knew that variable cost per unit, then it was easy to predict what that future variable cost was going to look like. Fixed expenses, also given to you that definition on a per unit and in total basis. The constant for fixed expenses are the total, right? A fixed cost in total does not fluctuate with volume. It's the per unit number that does fluctuate with your volume, because we were able to take that rent, that factory rent, which is the same every single month. But remember, when we increased our volume, we were able to spread that cost out over more units, and each one absorbed a smaller amount. So we learned variable costs and fixed costs, how to identify them if you're looking per unit and in total. And then to predict a fixed cost was even easier, right? It's the same regardless of volume. So where we left off, we were talking about mixed costs. Oh, we also did the step variable, which was fixed over a smaller portion, and to graph it, it looks like stairs, right? So we left off with the mixed cost, because the mixed cost is the more complicated of the different four categories, but it's really just a combination. It's a cost that has both a fixed and a variable portion to it. And if you're comfortable with fixed and variable, then basically you're doing the same thing and you're adding the two together. Okay, so before we move on, does anybody have any questions on variable costs or fixed costs? Anything that we talked about last class? Okay, everybody's good? Okay. All right, so we're talking here about predicting what a mixed cost is going to look like in the future. We know how to identify a mixed cost. A mixed cost has both a fixed and a variable portion. So we just went through last class, we said a mixed cost in total will go up as volume goes up, because there's a variable portion in there. And we also know, because there is a fixed portion in a mixed cost, you can identify a mixed cost per unit. It will go down as your volume goes up. So it's a little mixture of both variable and fixed. In total, it goes up as volume goes up, but per unit, it goes down because you have that fixed portion. All right, so how do you predict now what a mixed cost is going to look like in the future? And there are three different methods. We covered scatterplot or scatter graph already, but we're going to go through that again. And then high-low method is the one you're going to really want to know how to do, because that's what you're going to see on your exam. And then you also want to understand regression analysis. But the main one that we're going to be covering, that you're going to be using, is going to be the high-low method. Okay. All right, so let's go over scatter plot or scatter graph again. So remember, with mixed cost and with all three of these different methods of predicting what that mixed cost is going to look like in the future, what you need is past historical data. You have to keep track of what that mixed cost has been over a period of time. And then what you're also keeping track of is the activity that is driving the variable portion of that mixed cost. Right? Remember, you need a driver for variable costs. We saw the soda driver was going to be the friends that were coming over. What drives the cost of materials in a factory would be the more units that you're producing. So a variable cost is driven by some activity. So I'm going to keep track of the cost, that mixed cost, and then I'm also going to keep track of the driver or the activity that is driving that cost to go up or down. And then I'm going to take all of that and plot it. And if you have somewhat of a linear line from all of that data, then that's going to tell you that the driver is actually causing that cost to go up and down. Okay. So this is the data I gave you last class. This is the data in your textbook. This is Universal Sports. This is the retail company that sells sports clothing. And what you're looking at here is their delivery cost, right? Their delivery cost is a mixed cost. It has both a fixed and a variable portion. They pay for the service. They come in and in order for them to come into Universal Sports, they come every day to look to see if there's something to be delivered. If there's nothing delivered, you still have to pay for that service. But then also the variable portion is going to be based on the number of deliveries they have to make. Then if you have deliveries for them, they're going to charge you more. So there's a mixed cost here, the service, and then the more deliveries you have, the more that cost is going up, right? So take a look at this mixed cost. It's sort of all over the board. I have 1,875 in February, and then at one point in July, I have 4,800. So Universal wants to be able to better predict what this cost is going to look like next month in January. All right, so if we're going to use the scatter graph or scatter plot method, what I'm going to do is I'm going to plot all of these points, right? You're going to use all of this data from the past year, and you're going to put it on a scatter plot. Each one of these points is represented here, and you can see it's somewhat linear, which means that yes, the number of deliveries that you're making does seem like it's driving this cost to go up. When the deliveries are lower, cost is lower. When the deliveries are higher, the total cost is higher. So I know I have a good driver here. And so how am I going to predict then what this cost is going to look like next month? We're going to use a linear equation. And what we're going to do is I'm going to say visually fitting all of this data to the best of my ability. This is how this cost is going to behave, right? My cost is going to behave like this straight line. So there's a lot of subjectivity here, right? Because everybody's going to look at this data and visually fit that line a little differently, which is why you're not probably going to be asked to do this on your exam, because everybody's going to come out with a slightly different line. But you should understand how this works. I'm using all of the data and I'm going to visually fit this line in to the best of my ability. And then once you've done that, you're going to say the delivery cost behaves like this straight line. All right, so what we saw the other day is that once we have this line, I can get the slope of this line, and the slope of this line is going to be the variable cost per unit, right? We looked at those variable costs last class, and we saw that if the line is a straight line, the slope is your variable cost. And what we also know is the fixed cost, because we looked at the graphs for fixed expenses, the fixed cost is where this line is going to hit that vertical axis. So, you know, regardless of what happens, they pay $500 in fixed expenses. Then we also know, and if I get the slope of this line, that will give me my variable cost per unit, and then I'll be able to predict the variable portion here. So as a reminder, how to get the slope of the line. Remember, you're using rise over run, right? This is like a bring you back to middle school kind of thing, right? All of that good stuff. So if you're trying to get the slope of a line, what you need to do is find a point on this line. And it just so happens that when we visually fitted this line through, this one particular point is exactly on that line. So if this point is on that line, you can now get the slope of your line. You're going to look at the change in your cost from 500 to 2,600, and then you're going to be looking at the change in your volume from 0 to 1,500, right? So it's rise over run, change in cost, which is 2,600 and 500, and then the change in deliveries, 0 to 1,500. And if you take the change in your cost over the change in your activity or your volume, what you get is $1.40 per delivery. Right. So within this relevant range here, then I can expect every time somebody makes a delivery, it's going to cost an extra $1.40. Claudia.
So do you have to always use a point on the line? And if there is no point on the line, do you just use like a made up point, kind of?
You have to have a point on the line. So if there's if none of that data is on the line, then you need to get a point on that line. Yes.
Oh, okay.
So in order to get the slope, yeah, because you're getting the slope of that line. If it happens that you are visually fitting it through and there's no point, you need to use a point on the line.
Okay. Thank you.
Yep. Okay, so we're using the linear equation here, right? So what we're saying is delivery cost is going to behave like this straight line. So here's the linear equation, right? This is the equation for a straight line. So I know that the total cost, because Y is the total cost, total mixed cost, is going to be your variable cost per unit, which is constant, $1.40, we just calculated it, times expected volume. Right? In order to get total variable cost, it's variable cost per unit times expected volume. We know how to calculate a variable cost, right? We learned last class, variable cost per unit is constant. All I need to tell you here is how many deliveries are we expecting to make, because that will tell me my total variable cost. And then here's the fixed cost. Here's where that line hit that vertical axis. So next month, if you're trying to predict what this cost is going to look like, you know you're going to have to pay that 500. That's the fixed portion that happens regardless of activity, just like the rent that you pay. And then you're going to have to add the variable portion to that because the mixed cost is a combination of the two. So as I said, you know how to calculate variable per unit times expected volume. You know how to predict fixed. That's the easiest. It's going to be the same. Add the two back together and you have your projection for next month. Your delivery is going to behave like this straight line. Does it make sense? Okay. Okay. I'm just looking at the chat. Okay, so let's talk about the high-low method, because the high-low method is going to be very similar to the scatter plot or scatter graph method. So the only difference is going to be how you draw the line. So the high-low method is sometimes referred to as another quick and dirty method, right? So the visual fit method, very subjective. The thing about the high-low method, again, not too scientific, but basically what you're going to say is, based on all of that same data that we just looked at, I don't care about all of the data from over the past year, right? We've kept track of the data month by month. When you're using the high-low method, all you care about is the highest point and the lowest point from all of that data. And then you're going to say the cost will behave like that straight line. So here is how you're going to calculate high-low. And like I said, this is the one you're going to want to know how to do. So with high-low, from all of that data, you're looking for the high point and you're looking for the low point. And that is going to be your line. And then what you're going to do is you're going to get the slope of that line, and that will be your variable cost per unit, just like the scatter plot. And then once you have that, you can see where that line hits the vertical axis, and that will be your fixed cost. And then you're going to set it up in that linear equation, just like you did with the scatter plot. So all you're going to have is a slightly different line, because instead of visually fitting your line through all of that data, you are going to just use the high point and the low point, and that will be your line. And the reason why I'm going to be testing you on this isn't that it's much more accurate than the scatter plot. It's just that you'll all come out to the same answer, because you're all looking at the same data, and you should all be able to identify the high point and the low point. All right, so let's do it again. We'll use the same data, but we're going to do the high-low method here. So instead of plotting all of this data, what I'm looking for is the month that has the highest level of activity and the month that has the lowest level of activity. All right, so here's the number of deliveries. So which month is going to be the month that has the most deliveries?
July.
Trying to see. Is that Justin? No, who's saying that? I can't see. Okay. Brianna.
July has the most deliveries.
July has the most deliveries, looks like, and then the month that has the smallest, Jameson?
June.
June, right. So remember, you're looking for the high activity and the low activity. And then you're using the cost at that high activity and the cost at that low activity, right? So in order to choose the points, and this is important, you're not looking for the high cost and the low cost. You're looking for the high volume and the low volume. And then it's the cost at that high volume and the cost at that low volume. If you have a good driver, it should be your high cost and your low cost, but I'm just saying it's not always the case. You're trying to identify that low point and that high point. Right, so this is the high point, this is the low point. And so what I want to do then would be to get the slope of the line that would be drawn just using these 2 points. And if you're going to get the slope of that line, again, what you're looking for is going to be the change in your cost over the change in your activity. Right, so what I'm saying here, and I have it here, watch out for this. It is not the high cost minus the low cost. Look at this formula. It's the high activity, and then it's the cost at that high activity. You need that point, highest point on your graph. Then you're looking for the lowest activity, which was 600, and the cost at that low activity. Okay, so back here, right? So here is your high activity in July, 2,800 deliveries, and the cost is 4,800. The low level of activity is 600, and the cost at that low level of activity is 1,500. So I'm looking at the change in cost over the change in activity, and I get a variable cost of $1.50 per delivery. Is everybody good with that? Okay. Okay, so I have my slope, and I'm trying to predict what this mixed cost is going to look like in the future. What do I want next? If I know my variable cost per unit now, what do I want next? Adam,
Your fixed cost.
I want my fixed cost, exactly. So if you were to plot this line, if you had a graphing calculator, you would see that this line is going to hit that vertical axis at $600. But instead of plotting this line and graphing it, what you can do is just calculate the fixed cost. And take a look here, because what I have done here is I've done it twice, right? The fixed cost is the point where that line is hitting your vertical axis. And that line has only been drawn with these 2 points. And so when you calculate the fixed cost, you can double check and calculate it twice because it should be the same. It should be the fixed cost regardless of these 2 volumes, right? So let me show you how I'm calculating this. I know my mixed cost, which is my delivery cost, has both a fixed and a variable portion. So what I've just calculated is the variable cost per unit. That's going to allow me to take that mixed cost and back out my total variable, and then I should be left with fixed, right? Mixed has both fixed and variable. So here's my mixed cost, that delivery cost at the highest level of activity, 4,800. If I back out my total variable, I'm left with fixed. So how do I get total variable? I know the variable cost per unit is $1.50 per delivery. And when that cost was $4,800, I did 2,800 deliveries. So the total variable cost is that cost per unit times the volume of 2,800 deliveries. And if I back out total variable from the mixed, I get a fixed cost of 600. And again, this line was drawn based on these 2 points. So this should work for both of these points, right? So my mixed cost at the lowest level of activity was 1,500. I want to back out the variable portion of that, and I should be left with fixed. So I'm taking the 1,500. Again, variable cost per unit is constant, but here at this low cost, I only did 600 deliveries. So to back out total variable, it'll be $1.50 for 600 deliveries. And I get that fixed cost of 600. Okay. Is everybody good?
Oh, Professor, I had a question.
Yeah.
In that scenario, is the mixed cost also the total cost?
Yes.
Okay.
Yes. So moving on to this slide, that's exactly what we're looking at, right? So we're trying to figure out the total cost, and now we're kind of breaking it back, and now we're kind of moving forward. So the total cost is what we're trying to do here. We're trying to break that mixed cost down into its fixed and variable portions, because we know how to calculate or predict a variable cost, right? We know variable cost per unit times expected volume. And we know how to predict a fixed cost. That's even easier. It's going to be the same. So the whole idea here is that we're taking that mixed cost, which is the total cost, and backing out the variable to be left with fixed. Okay. And now that we know all of this, now we can project what the cost is going to look like in the future. Because here is that linear equation, right? Y is your total mixed cost. And I'm trying to figure out what it's going to look like in the future. And so I know it's $1.50. The variable portion is $1.50 for every delivery being made. And I also know now that regardless of the deliveries that are being made, $600 is the fixed portion that is happening every single month. A mixed cost has both the fixed and the variable portion. We are saying that our delivery cost is going to behave like this straight line. And so all I need to tell you then, next month, if I'm trying to predict what this cost is going to look like, how many deliveries are we going to make? Because I can calculate then the total variable cost. I would add it to the fixed cost, and then I can predict what that total mixed cost is going to look like. Make sense? Okay, so here's your question. What is the estimated total delivery cost next month if we're expecting to do 1,500 deliveries? And this is your poll question. Okay, I have almost all of you. So last chance, last chance. I'm going to end the poll. Okay, perfect. I have everybody. All right, let's see. 92% of you have it right, but not 100%. Okay, this is interesting. This is just the fixed portion, right? And this is probably just the variable portion. All right, so this is what I'm looking at. Most of you have it right, but let's take a look at how everybody got those different answers. Okay, so if I'm looking at my linear equation, all I need to do is plug in 1,500 deliveries, right? It's $1.50 for every delivery. Variable cost per unit is constant. Total variable cost is going to be calculated at $1.50 times 1,500. That would be the variable portion, but then you're adding the fixed portion as well, which means you are projecting that cost to look like $2,850. Right, so there was somebody that said the answer was 2,600. And I know why you said that, because you can see back in March, they did do 1,500 deliveries, right? We actually had a month when 1,500 deliveries were made and the cost was 2,600. So how does that work when we're saying it's going to be 2,850 when we've already seen it at $2,600? The reason is because, Ashley?
Because we're making a line of best fit, so it's different compared to the actual data.
Right, when we set up exactly with the high-low method, we only used 2 points to draw that line, right? So when we looked at this point right here, it was not on our line. We only used these 2 points and we said this cost is going to behave like this straight line. So when you are doing this, this is just an estimate based on, and I apologize because this slide doesn't look right. This line should be going through the high and the low point and should not be on that point, right? That point is not on the line, and so it's not going to be part of your estimate. Your line is drawn just using the high point and the low point. So remember, this is just an estimate, a way of predicting what this cost is going to look like. And using high-low, the correct answer would be that $2,850. Does it make sense? Okay. Okay, so the last method of taking that mixed cost and using this linear equation is using regression analysis. So regression analysis is going to be doing basically the same thing. We're going to say this cost behaves like this straight line. The only difference is that to draw that line now, instead of visually fitting based on all of the data or just using the high point or the low point to draw that line, we're going to use statistics to get the best line based on all of the data. But then it's still not going to, it'll be the most accurate way of estimating, but we're still not going to be able to say the delivery cost will be next month, this amount, right? So we're going to have the best fit, but we're going to be able to do this using Excel. So what I'm showing you here, Excel is so easy to use, or you can use a graphing calculator as well. You're trying to get that linear equation, right? Same data. So here's the cost, right? So remember, this is your rise, this is your y-axis, this is your cost. So if you want the variable cost per unit or the slope, there is, all you have to do on the left top is to go and pick slope, right? Excel is so easy to use. So you pick the function slope, and then you drag your mouse from C2 all the way down to C13. And then you're going to do the same thing for your volume. And then you're going to say calculate it, and it will give you the slope of that line, right? So just statistically looking at all of that data, they're going to not visually fit it, but use statistics to draw the best line. So once you know that variable cost per unit, you know what you're doing next, right? You need the fixed expense. Where is that cost going to hit that vertical axis? So using Excel, there's another function that says intercept. So again, you just go and you hit the function intercept, and you would do the exact same thing. You would do all of the costs and look at all of the volume. And then instead of saying slope, you would say, I want the intercept, and it would tell you where that line is hitting your vertical axis. And then you're just going to say, this cost will behave, here's the intercept here, like this straight line. Right, so as I said, high-low is what you're going to be responsible for knowing how to do, right? So if you're going to be asked on your exam to break a mixed cost up, it's going to be using high-low, not because it's the most accurate way of doing it. It's just that scatter graph you'd all be visually fitting a different line, and you wouldn't have the same answers, right? But with high-low, you're given the high point and the low point, and you don't need a graphing calculator, and you don't need to know how to use Excel. Right, so you should understand regression analysis and how it works, but you won't be asked to do it. And you should understand the scatter plots as well, but nobody's going to ask you to actually break that cost up on the exam. Okay, does it make sense? And I should tell you too, with regression analysis, one of the nice things about that is that it will give you something called R-squared, which will tell you whether the driver is a good driver or not. So you don't just have to visually, again, look to see how do those points look. Are they linear? You know, so it'll give you a range of whether you think that driver is a good driver or not. So 3 ways of estimating what a mixed cost is going to look like in the future. Again, none of the 3 are giving you the exact, but you don't need exact. You're just trying to get an idea of what that delivery cost is going to look like in the future. Okay. Questions? Everybody's good? All right, well, let's try. Well, before we do that, so what I'm showing you is we just did 3 different ways, right? And look how close all 3 of them are. So whether you're using statistics or the visual fed or just 2 points, if you have a good driver, you're like I said, the estimates are going to be pretty close. Oh yes, and don't forget that relevant range, right? Remember, all of this, that linear assumption is saying that the variable cost per unit is constant. The fixed cost in total is constant. But also you should know that not all costs are linear. In fact, most of them are not linear. You're just finding a range of volume where you can use that linear equation because it's so easy to make a prediction, right? So what I'm showing you here is, even though this cost isn't a straight line, for the idea of saying within this range, this is the normal range, can I make a prediction? You can say, not quite a straight line, but I'm going to say it is a straight line because I don't need to be accurate. I'm just trying to get some idea. Okay. Are we good with variable, fixed, mixed, relevant range? Everybody's feeling confident with those terms? Okay. Right. So since high-low is what you're going to be responsible for knowing how to do, let's just do one more problem here. right? So I'm going to ask you, here's the data. So I'll give you a minute. You can kind of think about as we go through, right? So I'll ask you to do the calculations and then I'll show you what the answers are. All right, so here is a company that has a photocopy. Instead of delivery, they have a photocopy service. So this is a mixed cost. So they have somebody in the building, right? So there, in order to, in case any photocopies need to be made, but then the more photocopies that are done, the more that cost goes up. So even if they don't do any copying for that particular month, they still have to pay for that fixed portion. It is a mixed cost. All right, so I'm going to be asking you, if you are expecting to do 5,800 copies next month, can you predict what the copy cost is going to be? And if you're using high-low, think about it as that 4-step process, right? Step number 1, find the high and the low point, because that's going to be the line that you are going to be using. So you've kept track over the last 8 months of what that cost has been, that mixed cost. And then also what's driving the activity that's driving that cost is the number of copies that have been made. Okay, so which month had the highest number of copies? And which month had the lowest number of copies? What is your high and your low points? Pak-Chi.
The highest will be at August, and then the lowest is February.
Okay, that looks good to me. February is 42, and that looks like the lowest, and then the highest is 71. So these are your 2 points, right? You're looking for volume first, and then it's going to be the cost, right? You need that whole point that you're plotting. And now we have this volume, and I want that cost. That is going to be the 2 points. The rest of the data does not matter. Okay. Can you get the slope of this line? What do I have to do? Kenzie.
You have to do like the total cost from August subtracted by the total cost in February over the change in units of level of activity.
Perfect. Change in cost over the change in volume, right? So you have the high volume, and remember it's high volume and the cost at that high volume. That's your highest point. Then here's your low volume and cost at low volume. Change in cost over change in volume is going to tell you that the variable cost or the slope of that line is going to be 10 cents per copy. All right, Adam, what would you do next?
For the second one, for finding the fixed cost.
Yep.
You'd multiply the 10 cents per copy by either the 71,000 copies or the 42,000, and then you'd subtract that answer from the total copy cost.
Exactly. Now that you know variable cost per unit, now you know your gold in calculating the variable portion of this, right? Because you know how to calculate a variable cost. It's 10 cents per copy. If I want to get the fixed portion of this mixed cost, I'm going to take that mixed cost at the high, or if you want to do it again at the low volume, and back out the variable, and you'll be left with the fixed. So I'm going to take the mixed cost of $7,300, and I'm going to back out the 10 cents per copy multiplied by 71,000 copies, because this cost was $7,300 when I did 7,100 copies. Variable cost per unit is constant. The volume was different when these costs were different. Okay, is everybody good with that? So now I can do my linear equation here. because I know the variable cost per unit is 10 cents per copy. And I know my fixed cost, no matter what happens, even if I don't do any photocopying, I have to pay the $200 in fixed cost. So I know that my photocopying is going to behave like this straight line. So now I can answer that final question, right? If I'm going to be doing, what did I say, 5,800 copies next month, can you predict what the cost is going to look like? Oops, I'm going the wrong way. And the answer is yes, because it's going to be 10 cents for each one of those 5,800 copies. And then another 200 because the fixed cost is not dependent on volume. So your answer is $6,400. Okay. Okay, and then the question asked you, just like I asked before, why does your estimate differ from the is that? Yeah. Oh, I'm messing this up. The answer is, oh, if we're doing 60, I'm sorry, I'm not reading this correctly. If you're doing 62,000 copies, your answer is 6,400. You're all nodding at me and I'm giving you the wrong numbers here. So the answer is 6,400. Why is that different from the 5,800 that you're looking at here, right? Because we actually did 62,000 copies in June and the cost was 5,800. So why does this number differ? Because this is a line that was based on just the high and the low point. We didn't use this point when we did that line, right? The line is drawn from just the high point and the low point. Okay, we good? Okay, the last part of this chapter, what you're going to learn here is going to set you up for the next chapter, chapter 3, and you are going to be learning a new income statement, right? So here's your learning objectives so that you are able to go back and make sure that when we're done with the slides, you're able to answer these questions. And no, you can't answer them yet, right? But this is just set up for you to study later, right? So we're going to look at the contribution formatted income statement. So this is a new income statement that you use almost all the time when you are internally running your company, right? So before we talk about our new statement, let's just review the old one, right? That traditional formatted income statement, it is used primarily for external reporting. In financial accounting, this is what you used for your income statement, right? Because you used or you learned how to prepare financial statements for external users, right? Here is my financial statement. 100% of the time, I'm going to say, if you're handing your financial statements to a bank or to an investor, you're going to see this traditional format. This format sets your expenses up by how they function, right? Remember, cost of goods sold is the first expense always that is listed after sales, and it's where you expense your inventory. I'm going to do a little review of that, but I'm waiting for some of the people that are taking financial accounting to get caught up with that. So if you haven't learned this yet, not a big deal. I'm holding off. We won't need it until chapter 4. But for most of you, you should understand that cost of goods sold is where you're expensing inventory, matching to revenue. Then also, after gross margin or gross profit is going to be your selling and administrative expenses. Basically, your traditional formatted income statement has your expenses broken up into function, inventory, not inventory. This new income statement is going to set your expenses up by how they behave as you start to make changes. So this new income statement is going to be your best friend as you're trying to run and make improvements in your company. Because what you're going to do is you're going to take these expenses and instead of saying inventory, not inventory, you're going to say variable or fixed. Because you're going to be constantly trying to, just like the example I gave you, up your volume from 40,000 to 50,000 units. and you need to know how your costs are going to behave as you're making volume changes so you can predict what that net income is going to be. And if you set your expenses up as variable and fixed, then you're going to be able to see that your variable costs are going to change right along with the volume, right? As your volume goes up, you can expect these costs to go right up along with that volume. But you also know that your fixed expenses won't be affected by any changes in volume that you're making. So you're going to see how these costs are going to behave as you are making changes, right? So let's take a look at the format here. The contribution formatted income statement is called contribution format because it calculates contribution margin. Contribution margin is different from gross margin. It's a completely different term. Contribution margin is what you have left from your sales after you've deducted all of your variable costs. And then you're going to subtract out all of your fixed expenses and you will get net income. You could think about that 40,000, that contribution margin. This is what you're going to have left after you've deducted your variable expenses to help contribute to covering all of these fixed expenses. Also take a look here. When I am restating my traditional format into contribution format, I'm not changing any of the expenses. All I'm doing is reclassing, right? Notice I have the same sales, exact same net income. All I'm going to do is I'm going to say this cost is now variable or this cost is now fixed. Okay, makes sense? This is just an intro, but this is your new income statement, and we're going to be using this pretty much for the rest of the semester as well. Internal, external. Okay, and this is just summing up what I just said. These new income statements sets up your expenses as by how they're going to behave as you're making changes in your company. All variable expenses are expensed above the contribution margin. All fixed come below the contribution margin. And your net income should be the exact same in both, right? You're not changing any expenses. You're just calling them by a different category. Okay, all right. So what I'm looking at here is our first consulting job, right? So here I have Morrissey Brown and Limited. They just started operations in July, and this company is really taking off, right? So what they've done is they've just called us up and they said, we just started business in July, and it seems like we can't keep our product on the shelf. And everything is just happening so quickly. We need some help in making sure that we have control over what's happening as this company really grows so quickly. All right, so as soon as I'm getting that phone call, what I'm going to want to do is I'm going to want to take this traditional income statement, and I'm not surprised they would give it to me this way because your accounting system is going to give you that traditional income statement. But I'm going to want to put it in the contribution format. Because if I have it in the contribution format, I'll be able to see how these costs are going to be behaving as this company continues to grow, right? So you can see July, they did sales of 4,500 in August and 5,000 in September. So this company's really taking off, right? So what we're going to do is we're going to take the month of September and we're going to restate it in contribution format. Okay. Except class is over now, right? Is class over now? Yes. All right. So you're going to have to save this fun for Wednesday. So no worries. All right. Just kind of think about, so what I would go back for up to this point is just review that high-low, because like I said, that's what you're, make sure that you have the high-low down. Make sure that you have variable, fixed, and mixed, and step down. And this problem is going to start to tie things together, right? So now we have one more class. So now I'm going to move into, like you can see, some problems that are not just going to ask you do this or that to kind of apply everything that we've learned. So good things set for you for Wednesday. Be safe in all the snow. No snow days for us anymore. Zoom has completely destroyed snow days, right? Which is a good thing, I suppose. I feel bad for the grade school kids. But anyway, I'll hang out if you have questions, but if not, I will see you on Wednesday.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.